Hello, and welcome to Hacking the Penny Stock Market. This is a series of exclusive video tutorials comprised of microcap and small cap stocks. But before we begin, I'd like to address some of the concerns over the title of this series. Don't be intimidated by the term hacking. This isn't a system designed to illegally compromise computer networks, but as a hacker, I use some of the same methods utilized in hacking, and then I apply them towards my stock trading strategies. A hacker, whether they are hacking ethically to augment the security of a system, known as a white hat hacker, or by violating laws to exploit a system with malicious intent, known as a black hat hacker, all have one goal in common, and that is they are seeking to exploit weaknesses and vulnerabilities within a system. I bring that hacker mindset to penny stocks and find weaknesses and vulnerabilities in penny stock companies so I can avoid the potential loss of a trade, or I can take advantage of the situation by capitalizing on the vulnerabilities. I show you how to make money as the stock goes up, but I also show you how to safeguard your money against losses as the stock goes down. When you watch these videos, I want you to visualize these penny stock tutorials like a computer virus. Think of it like this. If a computer virus's primary objective is to infect a computer system and rapidly spread itself, as your penny stock mentor, I want to infect you with a virus. Not just any virus, but a virus that spreads perpetuating wealth and prosperity to you. I want you to become infected with invaluable knowledge and wealth, and then pass that infectious virus of newly acquired wealth to your friends and family so they can live a meaningful and prosperous life. If you are looking to become a wealthier individual in a short amount of time, and by shorter, I'm speaking in terms of investing in some boring index fund, then trading penny stocks might be for you. Some argue that trading stocks is a form of gambling. That is just flat out wrong. Gambling is based on pure speculation and random chance. When trading penny stocks, on the other hand, there is a degree of predictability which can be achieved if given a well-structured strategy, which is what I'm going to provide you with throughout this series. If investing in the stock market was considered gambling, then investors like Warren Buffett and Carl Icahn, along with all the hedge fund managers making hundreds of millions of dollars per year, must be some of the luckiest guys on earth. Now, if you want to make the argument that the conventional stocks that aren't penny stocks are not a form of gambling, but penny stocks are gambling, then why should the two be differentiated? Is it the level of risk involved? If so, then at what point would a stock be defined as gambling, and at what point would it fail to meet the definition of gambling? Where do you draw that line? Anyone who says you can't get rich investing in penny stocks either A, doesn't know anything about penny stocks because they've never tried it, or B, they've tried it but they failed and lost all their money. Why did they lose all their money? Because they didn't have a strategy. They don't understand how the microcap and small cap markets operate. I do, and that's why I'm going to show you how to make money so you don't end up like the bitter loser that condemns investing in penny stocks. Don't let ignorant and pessimistic comments discourage you from reaching your financial goals. The truth is, you can become wealthy in a short period of time by trading penny stocks. I should know because I've done it myself. Maybe your goal isn't to become a millionaire trading penny stocks, which is possible by the way, but maybe you want to make 6 figures per year. Or maybe you just want to supplement your income by bringing in a little extra money every month. Maybe buy a new car and use your penny stock profits to make car payments for that brand new BMW that you've always wanted. In any event, you can use my strategies to satisfy your needs. The choice I leave to you. It ultimately depends on how determined you are to reach your goal. I currently hold a degree in finance with a minor in computer programming. This particular field of study might not hold much significant relation to penny stocks per se, but it's not completely useless either, unlike many of the college degrees out there. Now, throughout this course, I will make references to psychology, economics, statistics, business math, computer programming, and even physics. Don't worry if you don't understand these subjects. I do the hard work so you don't have to. I think we briefly discussed penny stocks in a couple of upper division finance courses, but the information was so limited, I can cover what I learned from my finance degree in just a few minutes. So I really try and fortify the point that you don't need a degree in finance to become successful in trading penny stocks. In fact, you don't even need a college degree at all. When I was about 9 years old, my parents had bought a computer with a Pentium processor that produced an astounding 75 megahertz, one of the fastest computers on the market at the time. And during this initial period, I began to delve into the world of computer programming. I began learning how to program and started developing small computer programs at 9, when most 9-year-olds were busy playing with Legos or preoccupied with cartoons. It wasn't until I was 14 years old when I became influenced by the dark side of the internet. I subscribed to numerous Usenet hacker news groups like alt.binaries.hacking and read 2600 magazine religiously. There are good hackers, and then there are bad ones. Some use their abilities to become internet vigilantes, and some help assist law enforcement to capture pedophiles, some expose government corruption, and I do exactly the same, except I expose the corrupt scams and penny stock companies. A lot of traders fail to recognize the scams, and that's how they wind up losing their money. One of my first computer exploits came many years ago when I knew JavaScript. Microsoft had just unveiled a new feature of their email service, Hotmail. They introduced this innovative concept that filtered your junk mail into something called a spam folder. When they implemented this feature, I quickly exploited a weakness in the JavaScript coding. I found a flaw. What I was able to do with this flaw was that I could create a malicious link that could be displayed in your email. When the link was clicked, I figured out a way so that it would select all the messages in your inbox, send them to your trash bin, and immediately empty your trash bin. These actions would execute almost simultaneously, so your entire inbox would be completely wiped out just by clicking a link in your email. In hacking, this is referred to as a zero-day attack. Since I created the attack, software developers at Microsoft were unaware of this vulnerability, so a patch was not yet developed. One of the best times to hack any computer application is when it's new to the market. And that's what I do with penny stock companies. Many are startups, and a lot of them are scammers. So I find weaknesses within their company through extensive investigations by using the same tools and strategies utilized by private investigators, which I show you how to do later. I notified Microsoft and I got nothing but an automated response thanking me for my inquiry. Too bad I couldn't bet on the flaw to capitalize on it, but luckily I can exploit flaws in many of the stock companies, especially the fraudulent companies. I will teach you how to ride the wave and make money on a booming stock, but I will keep you one step ahead of the crowd by showing you how to identify the weak and vulnerable companies that everyone finds so favorable so you don't end up losing money like the majority of penny stock traders. Just this year, I made a 936% gain on a single stock. That particular stock, a marijuana stock, ticker symbol GRHN, netted me over $32,000. And I made that money in less than a week by investing only $3,500. Even if I had invested just a few $100, I still would have made several $1,000s in just a few days. Most importantly, it was not some haphazard approach or by random chance that I had made that money. No. There was a strategy involved. I had used my personal strategy to know when to buy the stock and when to sell it. And I teach my strategies to you so you can know when and how to buy and sell your stock to truly maximize your profits. A lot of penny stock instructors will try to astonish you with their profits per trade. Many claim they make several $1,000s per trade by day trading. But what they don't tell you is their position size. The deceptive tactics are there only to fool the gullible. Many hackers, such as myself, can easily spot deception because, that's what we do. So how do they do it? If they tell you they made $4,000 in a single trade by day trading a penny stock, find out how much of that percentage gain they made on that trade. Now, most day traders make just a few percentage points per successful trade. So if they made 5% on a single trade and they made $4,000 profit, you just divide 4,000 by 5% or 0.05 and you get 80,000. That deceptive instructor's position size was $80,000, meaning they had to invest $80,000 to make the $4,000 profit. And most beginner penny stock traders don't have $80,000 to invest on a single stock. But with my strategy, I teach you how to make that kind of money without large position sizes that most traders can't afford. When I was at the university, finance students had access to a Bloomberg terminal. A Bloomberg terminal is a computer system that permits access to Bloomberg's proprietary subscription service that delivers market data to individual investors and institutional firms. Many subscribers are hedge fund managers, and it's highly favored by many investors on Wall Street. The average price for a Bloomberg terminal costs over $2,000 per month for their services. Now, I've passed the Bloomberg Essentials training program, and I have my certificate in Bloomberg Equity Essentials. I find the service to be highly valuable for the latest news and resources, but I don't recommend it for most traders because a lot of the features are a little excessive for penny stocks, not to mention the price range is a little costly for some penny stock traders. I'd post a picture of the terminal, but Bloomberg is highly unreceptive to posting any information that was obtained from the terminal, including screenshots of their application, but you can find screenshots on the internet if you so desire. I'm the guy you hated in math class. Why? Because I'm the guy who got straight A's and 4.0s in math. I was the guy who corrected the instructors when their answers were wrong on exams. A lot of people hate math and made me struggle just to get through algebra, but I got an A in calculus and enjoyed every second of it. Knowing this, I perform a lot of mathematical equations, so you don't have to. I'm even trying to construct my own mathematical formulas designed exclusively for penny stocks. I've developed an equation which is an adaptation of a very fundamental law of physics known as Isaac Newton's second law of motion. We'll discuss this in just a bit. So, why did I mention all of this? Is it because I'm some egotistical prick? Well, perhaps. But seriously though, I mention these things to you because I want to assure you I know what I'm talking about. I don't know any other trader or penny stock instructor who has a degree in finance, who is also a computer programmer / hacker, is certified to use a Bloomberg terminal, and got A's in calculus. I'm sure there are others, but they are far and few between. I have many years of trading experience and the smarts to help guide you and teach you so that you can make the right financial decisions. Since I was young, I would always question everything. I never seemed satisfied with answers that led to circular reasoning or dead-end conclusions. I've always preferred logical and rational explanations for why things happen or how things work. Now, one day I asked myself, why do so many women look for a well-established man with money? It doesn't matter if he's fat, old, ugly, or a combination of all three, just as long as he's got money. If you don't think your wife or girlfriend cares about money, quit your job, sell all your possessions, and go live on the street and watch how long she'll stay with you. Some might say that's just how females are. But I think the answer lies deeper than that. So, back to my question. Why are some women attracted to men with money? The dawn of the human species, the Homo sapien, dates back to approximately 200,000 years ago. During our hunter-gatherer days, we relied on our primal instincts and our ability to hunt. This was a period when human existence was dependent on strength and agility. It was survival of the fittest, literally. In order to increase a woman's rate of survivability, she would consort with a man who possessed great strength and agility, and that is why women are attracted to the man with money. A woman has a better chance to survive when she's with a wealthier man, much like when she was with a healthier man during our hunter-gatherer days. Now, these evolutionary traits have been carried over the past couple 100,000 years into our modern female. This could also explain why women today are attracted to men with large muscle mass and six-pack abs. In our society today, we are no longer dependent on our ability to hunt for food or strength to survive, but our ability to make money. Money is the resource in which the human species can coexist to increase our chance of survival without hunting and killing for food and shelter. And it's these same behaviors of the Homo sapien which can be traced back to about 200,000 years ago. Now, for you males out there, I'm going to show you how to acquire wealth in the stock market so you find a pretty female to accompany you in that brand new sports car. If you already have a wife, then maybe she can be your mistress. Now, if you're a female, I'm going to teach you how to become financially independent without having to submit to another person's bank account. All right, so back to volatility. Volatility is how we measure the variations in price for any financial instrument, including penny stocks. One method we use to measure volatility is through standard deviation, and it's denoted by the Greek letter sigma. Standard deviation scales a series of data against its mean or average. In penny stocks, we want a standard deviation that's farther from its mean or average. This next image should look familiar to you. It's called a bell curve, and in statistics, we call it a normal distributions or sometimes Gaussian distributions. Now, this is the formula used to calculate standard deviation. It's actually not as difficult as it appears. I'm not going to review this subject in detail, but just know that we want stocks that have a protracted distribution, which entails higher standard deviations. And this alludes to stocks with volatility. So, why is volatility such a crucial aspect to making money in penny stocks? Well, because volatility allows you to make substantial profits with just a little amount of trading capital. The higher swings in prices contributes to higher percentage gains. Now here's how it works. Say a penny stock is trading at 15 cents per share and it increases by 50 cents to 65 cents per share. That's a 333% gain on my investment. But if I were trading a blue chip stock priced at $100 per share and it increased by the same amount of 50 cents, that would equal just 0.5% or just half of 1% gain, even though they both had a 50-cent increase in price, thus making the penny stock more attractive. Okay, so if I invested $500 in the penny stocks, I would have made a $1,665 profit. And if I had invested that same $500 into the blue chip stock trading at $100 per share, I would have made a disgraceful $2.50 before commissions and fees. So I would have actually ended up with a loss if you include all the fees associated with trading. And in case you were wondering, blue chip stocks represent established companies like Coca-Cola or Microsoft. Beta is a term you probably won't see very often by penny stock traders because many have never heard it before. Alpha and beta are terms used by portfolio managers, hedge fund managers, and other professional investors, but it can still be used by penny stock traders as well. Now, when we talk about beta, we're describing another method to measure volatility or risk. Beta is the risk of a stock relative to the risk of the same stock, or it could be compared to the volatility of a particular benchmark. I'm not going to complicate things with detailed computations, but just understand that a beta of less than 1 is generally less volatile than the market or benchmark, and a beta greater than 1 is generally more volatile than the market or benchmark. And as penny stock traders, we are seeking stocks with a beta greater than 1. We want high beta. One of the primary causes for volatility in penny stocks has to do with a problem involving liquidity. Liquidity issues pervade the penny stock market like a cancerous plague. I'm going to show you how to elude some of these barriers. Liquidity itself is demonstrated as the degree at which a buy or sell transaction is efficiently facilitated. In other words, if I buy a stock and my order was processed within, say, milliseconds from when I bought the stock, I would say the stock is very liquid. If that process took minutes, hours, even days, I'd say the stock is illiquid. Real estate, for example, is a very illiquid asset. You can't just decide to place your house on the market today and expect to sell it within the next couple of minutes. Now, the same holds true in penny stocks. It might not be as illiquid as real estate, but there are many penny stock companies that are inundated with illiquidity, and this occurs because the stock consists of fewer market participants. I've been in stocks where I tried to sell for hours, but I couldn't because nobody else wanted to buy. So I was stuck with these shares that I didn't want. There is a manner in which we can identify illiquid stocks beforehand to avoid impending apprehension. How this is accomplished is that you find stocks with an adequate quantity of volume. Now, volume is simply the number of shares traded in a stock during a given period of time. You want to find stocks with a lot of buyers and sellers. Now, I prefer stocks with at least 50 to 100,000 shares traded per day. Now, the smaller the amount of volume, the more illiquid your stock is going to be. Now, liquidity is one of the many reasons why investors avoid penny stocks. But the absence of liquidity, when compared to blue chip stocks, provides us with more volatility, which equates to higher percentage gains. So, in essence, we want some form of liquidity because this generates more volatility, which produces higher percentage gains. So, people talk about owning stock, but really, what does that mean? What are stocks? When someone says they own stock, what they really mean is that they possess ownership of a company traded on the stock market. Back in the day, companies used to issue pieces of paper called stock certificates to shareholders. Now, a shareholder is just another term for someone who owns stock. Note that the term stocks and shares are interchangeable. So every so often you might see the term stakeholder, which is also synonymous with shareholder. So shareholder, stakeholder, and stockholder mean the exact same thing. It is an individual or firm that owns stock or shares of a company. And today, most stock ownership is facilitated through the use of electronic networks. And just because you own part of the company does not entitle you to walk into the business headquarters and demand the CEO to be fired. And corporations don't operate like that. It's like saying you should be allowed to walk through the White House anytime you want because you pay for part of the utilities and maintenance costs through your taxes to the federal government. Now, in order for the CEO to be terminated, the board of directors are the ones who fire corporate executives. Shareholders, owners of the company stock, are the ones who vote for the board of directors. And the voting process typically occurs during the annual shareholder meeting, which is a public gathering that occurs once a year, and it is required by law for public companies to hold annual shareholder meetings. If you can't attend, then you can vote by proxy, which it allows someone else to cast a vote on your behalf. Now, voting by proxy is typically conducted online, but you may be able to vote by mail as well. Now, at the meetings, shareholders vote on corporate policies, and they appoint board of directors and discuss dividends. And dividends are portions of a company's earnings that are distributed to shareholders. We won't be discussing dividends much throughout this course, since many penny stock companies don't issue dividends. Now, the reason why this is because many penny stock companies are startups with very limited capital, so they would rather allocate their earnings to expand their business, acquire other businesses, or keep the money for themselves. Also, because many penny stock companies are failing and they don't have additional capital to distribute to shareholders. We need to distinguish between the different types of stocks that are issued by corporations. There are two types of stock: common stock and preferred stock. Now, most stocks issued are common stock, hence the name common stock. Holders of common stock have the ability to vote during an annual shareholder meeting, while preferred stocks typically aren't granted that authority. The downside to common stock is that if the company is going to file for bankruptcy, common stockholders are the last to receive their money in the event of liquidation. Preferred shareholders, on the other hand, are paid before common stockholders, and bondholders have precedence over preferred and common stockholders. So bondholders are generally the first to receive their money. Now, a bondholder is someone who is usually aged in the mid to upper 50s, has a bland personality, and probably drives a Lincoln. All right, so maybe I'm being a little too cliched, but that's what I envision when I think of a bondholder. It's funny because when I attended a Bloomberg seminar, the host said that when you visit the bond section of the Bloomberg terminal, the interface is different than the rest of the areas, and that's because a lot of the bond investors are quote-unquote mature investors, and then they tend to be more old-fashioned, and they got mad every time Bloomberg changed the format, so they just kept the original formatting for the bond section because that's what the bondholders wanted. They didn't want the change. So anyways, by definition, bonds are a debt investment, and as an investor, you loan money to an entity such as the government or a corporation, and they're obligated to pay you interest for a specific period of time. To put this into perspective, let's say that you want to finance a new vehicle. A creditor will issue a car loan, and you pay them interest for letting you borrow that principal. With a bond, it's the same concept, except reciprocated. You are now the creditor, and the business is the one borrowing money from you and paying you interest. Sadly, the taxpayers have to cover the cost of interest payments to U.S. bondholders. Now, we won't be discussing bonds since they are somewhat irrelevant to penny stocks, but you may see the term thrown around by other investors or traders. Outstanding shares. Okay. Outstanding shares is easily described as the total number of shares held by investors for a particular company. This is not the same as the number of total shares traded on the stock market, because outstanding shares are also comprised of restricted shares, which are owned by insiders and company officers. Now, it should be noted that outstanding shares are not fixed, but fluctuate greatly over time. We will be referring back to this term in subsequent videos, so don't forget it. Now, if you're looking for the total amount of a company's shares that are openly accessible on the stock market, then look no further. The float is what helps us determine how many shares of a company can be traded by the public, and it's calculated by subtracting total number of closely held shares from outstanding shares. More often than not, you will overhear traders say something along the lines of, I'm long on Microsoft, or I'm bearish on JCPenney. Whenever you hear someone mention that they are long, that means they bought the stock. You might also hear the term bullish, which indicates that, according to their own predictions, the stock will rise. If they're bearish, that indicates their overall sentiment is ostensibly negative, and they predict the stock is going to head lower. If you can't remember the terms bull and bear, let's illustrate an example by imagining a charging bull. It tends to thrust its head in an upward motion, and when the bear is standing tall, it tends to swing its razor-sharp claws in a downward motion. Now, I see this a lot in penny stocks. Traders will obscure words like short-term, long-term, or investing in trading. For example, some traders claim they are holding stock long-term, but only to be interpreted by others as being short-term. Some of these misunderstandings may emanate from how they perceive what is long-term and what is short-term. Now, what we need to do is apply the definition to avoid any confusion. General consensus among traders and investors is that short-term can be defined as any financial security, such as a stock, to be held for less than 1 year. Any financial security that is classified as long-term is said to be held for more than 1 year. Based on my presumptions, this may have something to do with the capital gains tax. Now, capital gains is the tax you owe for your stock investments when it's time to pay Uncle Scam. Capital gains tax states that any profits or gains accrued on a stock that is bought and sold under 1 year should be taxed at the short-term capital gains rate, and any gains procured by the selling of financial security that was held for more than a year would be taxed at the long-term capital gains rate. I think I should make a very distinct clarification between a trader and an investor. With a lot of penny stock traders or investors, the two terms are seemingly used interchangeably, when in fact they are quite different in meaning. A trader is simply someone who places more frequent trades on a shorter term basis. And an investor is someone who buys and holds a financial security for the long term, generally for years or even decades, just like Warren Buffett. Now, the typical investor gradually increases their wealth through a diversified portfolio consisting of many different financial instruments that tend to be a little more risk averse. Many investors favor compounding interest by reinvesting their earnings, and they are very attentive to company dividends. In order for you to make $1 million at a compounding rate of 20% per year, now, it would take you about 25 years to reach that goal if you invested $10,000 today. Now, there's a quote circulated on the internet by Albert Einstein. I'm not sure if it's true or not, but rumor has it that he once said, "The most powerful force in the universe is compounding interest." The market is saturated with a variety of unique trading styles. Every investor and every trader has their own personal preferences. Now, it's not much different than in the real world. Some people don't eat meat, some eat a lot of meat, others may prefer Mexican but not Italian food, some enjoy fast food, others hate it, but I'm the guy that likes a little bit of everything. Unless it's the really exotic food, like the stuff you see on TV like monkey brain or horse testicles. That's a little too much for me, but I'm pretty sure they're probably healthier than a Big Mac. Anyways, when it comes to trading strategies, many expert instructors will try to convince you that they have a secret strategy or magical formula. Well, I'm going to be real with you. I don't believe in secret strategies when it comes to the stock market. Now, the truth is, predicting the future outcome of any event in the stock market with absolute certainty is impossible. What can be said is that while there are numerous trading strategies out there, they all have one goal in common, and that is to make a profit. Some are just better than others. It's almost like baseball. There are a number of pitches to throw, from two-seam fastballs to knuckleballs, and there are pitches you want to avoid, such as throwing underarm pitch like a little league or during a major league game. Now, even if you're an outstanding pitcher and you already know how to pitch, you still need to understand what to pitch and when to throw it. Just as there are many ways to throw a ball, so too are there many strategies to make money in penny stocks. You wouldn't pick just one particular pitch and continue throwing that pitch down the middle of the plate each time, would you? Now, if you did, you're bound to lose. And that's why I'm going to be your pitching coach. I will teach you what to pitch, how to pitch, and when to pitch it. I will teach you how to become a major league player. In the realm of penny stocks, you will see that the majority of traders are day traders. And day traders have the tendency to be a little impulsive and impatient. It's not so much that day traders are impulsive, but penny stocks tend to attract those who are more impulsive because it allows a way to generate large sums of money in a short period of time. And who wants to waste time saving money into some retirement account to accumulate hundreds of thousands of dollars in 30 or 40 years before you get to spend that money? We want money now. Maybe that's why it's so appealing to the impulsive and impatient. Day traders execute multiple trades by buying and selling stocks intraday. Now, intraday is a term used to reference any time period that occurs during the course of a single session, starting when the market opens until it closes at the ring of the bell. Day traders are beneficial to the stock market because they provide liquidity to other market participants. They enable a smoother and expedited transaction when buyers are looking to buy and sellers are looking to sell. A lot of novice day traders with limited capital have to worry about something called commission fees. Every time you place a trade, whether you buy a stock or sell a stock, you have to pay a commission fee. Many average around $10 per transaction, and if you're making multiple transactions per day, the fees can really start to add up. What many penny stock traders need to do is they need to broaden their horizons. Take a moment to study the diverse opportunities available to them. Sure, day trading might suffice, but what if you really excelled in long-term investing? How would you know if you didn't try? Yeah, I made money day trading, but my success never really flourished until I tried something called swing trading. Now, I've helped other penny stock traders in their conversion process as they diverted from the dynamic flows of day trading to the more collected aspirations of swing trading, and I'd say the results have been very positive. A swing trader will place a trade and tend to hold the position for a longer duration than the day trader. Sometimes trades may be held for weeks, even months, but on average, especially given the speculative nature of penny stocks, most swing traders will hold a position for just a few days, even a single day. Now, this is great if you want to trade but don't have the time to sit in front of a computer all day monitoring your trades. Who wants to sit in front of a computer several hours a day? If you work a full-time job, even a part-time job, you won't be able to day trade. But with swing trading, all of that is possible. I'm able to do some grocery shopping while I'm still holding several stock positions. You can forget this method if you are day trading. Day trading warrants marginal freedom when it comes to financial losses. But as a swing trader, I can endure a greater loss because swing trades contain bigger swings, ups and downs, hence the term swing trader. A 5 to 10% loss can be insignificant to a swing trader because I can earn over 20% gain on individual trades based on my strategy. But if I were day trading, that would not be the case. A 5 to 10% loss on a single day trade is significant because I might only make 1 or 3% on a single trade as a day trader, maybe even a little less. So what I'm getting at is that when your average losses are smaller, you have to monitor your trades more meticulously. Now, I have a general rule that I've created, and that is the longer the duration you plan on trading or investing, the less amount of time you need to monitor your trades. And the same holds true for the shorter the duration you plan on trading, the more quality time is needed to monitor your trades by analyzing the stock charts. Before I discuss the act of scalping, I need to make it clear that the term scalping is a homograph, which implies that it's a word that's spelled the same but with two entirely different meanings. You'll see the term scalping every so often, usually in reference to a form of market manipulation. Scalping in this context is regarded as a highly illegal practice in which an individual or firm will recommend a stock to be highly valuable in the long term to unsuspecting traders. Now, these oblivious traders begin to buy the stock, and as the price of the stock moves upwards, the manipulating individual or a manipulative firm then immediately sells their position, hoping to make a substantial profit as the price is climbing and the unsuspecting investors are left with worthless stock. Now, this deceptive tactic happens a lot in penny stocks, and it's one of the many ways penny stock traders lose money because they fail to understand what is happening. Now, this is one of the methods I teach you how to avoid and profit from legally, which we'll discuss in greater detail later in this video, as well as in the 5th video of this series, the penny stock chart patterns. Now, the alternate description of a scalper is much different. In the Forex market, you see a lot of scalp traders. Now, it wasn't until I started trading Forex that I became familiarized with the term. A scalp trader or scalper is an individual who places numerous trades throughout the day, holding their position for mere seconds to a matter of minutes. scalpers are like day traders on crack. They make their money by placing hundreds of trades a day and capturing very insignificant gains per trade. I mean, we're talking fractions of a percent. I think a more fitting name for scalpers would be scavengers because they're constantly nibbling little bits of the stock like a scavenger. Let's play a game. In this game, you take 3 willing participants: a scalp trader, a day trader, and a swing trader. Now, the scalper makes an average $5 gain per trade, and the day trader earns an average of $100 per trade, and the swing trader makes an average of $500 per trade. Now, if I asked them how long would it take you to make $1,000, it would take the scalper 200 profitable trades to make $1,000, and it would take the day trader 10 profitable trades to make $1,000, and it would take the swing trader only 2 trades to make $1,000. Now, you also have to consider that there are commission fees and other hidden costs associated with the trades. Now, the problem with scalping and day trading for those with limited funds is that you have to spend a lot in commission fees. A scalper in this case would have to spend over $4,000 in commission fees alone if you're paying $10 for each transaction, since there are 2 transactions per trade. The scalper would be paying $20 per trade times 200 trades, which is $4,000. Ouch. Now, the swing trader, on the other hand, would have to only spend $40 in commission fees. If you want to make a substantial profit by scalping, you need to take large position sizes to offset your losses. And we're talking maybe $10,000 minimum per trade just to make a little $40 profit per trade. Of course, this game is just a hypothetical scenario, but it should allow you to see some of the benefits of the different types of trading strategies that are available. Does this mean that I don't day trade and scalp? Well, absolutely not. There are times when I need to day trade, even scalp certain positions, but I'm going to teach you when and how to utilize these positions when we discuss time periods later on. Now, part of my trading strategy is that it involves all of the trading styles. You just need to know when to use them. The 2 most widely used styles regarding penny stocks is day trading and swing trading. A position trader is the exact opposite of a day trader. They are placing trades on a monthly and yearly basis, much like a long-term investor, but the position trader may still be more focused on the overall price direction rather than moderately accumulating wealth by compounding and company dividends. I think this next trading style is worth mentioning since it's probably the most fascinating one. HFTs, or high-frequency traders, have gained a lot of notoriety with financial media outlets. High-frequency trading consists of making millions of trades per day, usually at the millisecond level, and this is the realm where HFTs operate in. Placing high-frequency trades are not humanly possible, so they're executed by using computer algorithms. While many investors and traders are trying to find ways to outperform on the basis of fundamentals or technicals, the high-frequency trader doesn't care about a company's financials or the price direction per se, but their approach to acquiring a profit is based on the notion of speed. It's an algorithmic race where the fastest methods are the most profitable. Someone spent hundreds of millions of dollars building infrastructures to enhance the transmission process of market data just to shave a couple of milliseconds off of their latency to gain a competitive edge. Computer networking latency is, in layman's terms, it's delay, and HFTs are trying to diminish latency. Light is a critical function for high-frequency traders, and some are looking into beating, quote-unquote, beating the speed of light. Now, in physics, this, of course, is an impossibility given Einstein's theory of special relativity is held valid. HFTs are starting to dominate the stock market as they comprise more than 50% of all stocks traded on the market. Now, unsurprisingly, the high-frequency trading industry has been met with some criticisms. Now, I'm not going to expound on all of the disparagements because it could take many hours to explain, but one of the greatest concerns with respect to high-frequency trading transpired on May 6th of 2010. That day will always be remembered as the flash crash. Now, the entire market was affected by this single incident where a minor glitch in the computer algorithms caused the entire market to plummet. Some stocks like Procter & Gamble collapsed to the price of just a single penny, while others reached tens of thousands of dollars per share. And within just a few minutes, stocks rebounded back to their more rational price levels. And all of this utter chaos was attributed to HFTs. I think my favorite HFT incident is the one that involved Obama, Twitter, and hacking. Now, some algorithms have the ability to scan news feeds and social media and then execute trades based on the overall sentiment of the news being published. For example, if the media reported breaking news that North Korea just declared war with the United States, computer algorithms could interpret this as potentially harmful news, and the algorithms would automatically sell stocks, whereby an influx of selling would continue to drive the entire stock market downwards. And that's exactly what happened in 2013 when the Associated Press's Twitter page was hacked. Now, the hackers issued a fictitious tweet that read, "Breaking: 2 explosions in the White House and Barack Obama is injured." Now, this tweet had sent stock prices downward for a brief moment until investors were informed that the AP Twitter was hacked. Now, a Syrian electronic army claimed responsibility for the hack, but they'll take credibility for any malicious attack on the United States. Now, I'm not one of those crazy conspiracy theorists, but I have a conspiracy theory I'd like to share with you just briefly. I postulate that it wasn't any Syrian hacker group that conspired against the AP, but the attack was methodically orchestrated by some large hedge fund or HFT firm that hacked the Associated Press, knowing that algorithms are reading the news, thus would trigger massive selling during the initial release of the news, and in turn generating a substantial profit for any and all parties involved. So now that we've covered most of the trading styles, I think it's time we direct our attention to this next section, trading strategies. And first up is algorithmic trading. So there's all this talk about algorithmic trading, but really, what is it? Now, I was introduced to algorithmic trading a few years ago when I started trading the Forex markets using Metaquote's MQL4 programming language. Automated trading, algo trading, and black box trading are all synonymous expressions which describe pre-programmed computer code that distributes commands to an electronic platform which then issues automated orders. A simple example could easily be illustrated if I wanted the computer to automatically buy a stock that's currently trading at, say, $40 per share, and then when it hits the price of $42 per share. I could be in the shower, I could be sleeping, or I could be on vacation, and the computer doesn't know, nor does it care. It simply obeys my instructions because that's what I programmed it to do. Now, this may seem fairly easy, but I can assure you it gets much more complicated because market conditions can be rather unpredictable at times, thus requiring very sophisticated computer algorithms. Trend trading is a strategy that implicates the current momentum of a stock in a particular direction, either up or down, and will continue its existing course in the future. So if the current stock has been bullish for several days, it is said to have been trending upwards for the past several days. Trends can exist in any time frame for any trading style, such as trends occurring intraday for the day traders, daily and weekly for the swing traders, or monthly and over the course of many years for position traders. Trending can also arise in a single stock, an entire industry, or even the entire market. This strategy becomes useful when certain sectors in the stock market are thriving. In penny stocks, you will see a lot of upward trends in biotech companies as well as pharmaceuticals, shadowed by a number of downtrends. You also see a lot of trends in the energy sector, so keep an eye out for that. And sometimes newer technologies begin to catch on and start trending. I remember back in 2012, there was a lot of hype surrounding the 3D manufacturing industry as the 3D manufacturing stocks began a 2-year upward trend. In the beginning of 2014, just after the legalization of recreational marijuana in Colorado and Washington state, marijuana stocks exploded. And if you have the profound ability to identify trends, especially before they happen, you will benefit from this trading strategy immeasurably, just as I have. One of the primary weaknesses that trend trading encounters is that a large portion of penny stocks are not trending up or down, but they are trending sideways. A sideways trend is pretty self-explanatory. The price action remains relatively stable, and its movement is sort of directed in a horizontal fashion. The reason why this occurs often in penny stocks is because a lot of stocks have very little volume, indicating that buyers and sellers are not interested in the stock. To really make money in the penny stocks, you should try to find stocks with respectable amount of trading volume. Although respectable is a relative term and it's open for interpretation. I typically like penny stocks with an average daily volume of at least 100,000. Of course, this number varies depending on the stock. If the stock was trading sideways yesterday and the average daily volume was only 13,000 and you notice the stock is taking off, you can disregard the 100,000 minimum level. So we will discuss this in more detail in an upcoming video, so don't worry about it too much right now. Momentum trading is often regarded as being synonymous with trend trading, when the two are very distinctive trading strategies. To alleviate some of this confusion, it would be appropriate to define the word momentum and then apply it to the description of momentum trading. According to the Webster's Dictionary, momentum is the strength or force that allows something to continue or to grow stronger or faster as time passes. This might sound similar to trend trading, but I can assure you it's not. Momentum trading is understood to be generated by events such as company news or the release of company earnings, but the underlying cause is actually hidden beneath the surface. There's one central principle that separates trend trading from momentum trading, and that characteristic is volume. That's right. The primary driving force behind momentum trading is volume. Just because the stock is trending does not imply that it has significant volume. I've seen stocks trending in one direction for many years, yet it had very little volume moving the stock. Trend trading can be short-term or long-term, but momentum trading is almost always short-term. Remember that when I refer to short-term and long-term, that's indicating that short-term is a period less than 12 months, and long-term is a duration that persists for more than 12 months. So one day, I was researching momentum indicators for stocks, and I started to notice something very peculiar about the formula used to calculate momentum. And upon my observation, I found it to be a very poor representation of momentum. The method used to calculate the formula for momentum is just the last price minus the price of a stock X days ago. All this infantile calculation infers is that it's really just the difference in stock prices. When you think about it, this particular formula doesn't calculate anything. It's like saying, I drove my car 30 feet from where I started and it took me 4 seconds to get there. This has no relation to actual momentum whatsoever. Now there's another example. Let's assume that you were standing at the bottom of a small ramp wearing a blindfold, and I told you I would roll a mysterious object down the ramp, and your goal was to stop the object from rolling. Now the only data I presented to you was how far the objects traveled from the top of the ramp to where I was standing, and how long it took to get there, which is equivalent to the misleading momentum formula M equals V minus Vx. Now the problem is that I've omitted a crucial piece of information. If I told you I rolled a soccer ball down the ramp, you could be able to stop that momentum. But what if I told you the mysterious object was a vehicle? Would you still try to stop the momentum? I noticed there was a key component that was missing, and what the formula fails to address is the object's mass. That is the missing component. So what I did was I adopted the momentum formula used in physics and substituted it to fit the company's stock price. In physics, momentum is described as the property that a moving object has due to both its motion and its mass, or simply put, mass in motion. The formula to characterize this expression is written as P equals M times V, or momentum equals mass times velocity. Physics uses the letter P, a capital P, to denote momentum, which derives from the momentum of a particle. There is unfortunately another problem that I faced. Stocks don't contain mass in a scientific sense, but there is an indicator that possesses similar attributes. Since we have nothing to substitute for mass in the stock market, we can, however, replace mass in the physics momentum equation with volume. But volume alone cannot replace mass, because if you have a stock with daily volume of 5 million, that doesn't say much about it. That's like asking how heavy an object is, and all you're given is the height and width of the object. That doesn't say anything about its weight. For all we know, it could be filled with air. So mass times velocity is what creates stock momentum, not a change in stock price like the traditional momentum formula. Now, the revised equation borrowed from physics can be written mathematically as follows. Momentum equals volume times velocity. And the velocity of a stock is calculated by change in D divided by time, or simply the price difference over the time. If you're looking to make a lot of money in a short period of time, you need to focus your attention to this trading strategy. Momentum is where the money's at, literally. Contrarian trading is when your views are contrary to the widely held beliefs of the vast majority of traders and/or investors. When the world believed that the sun revolved around the earth, adopting the geocentric model, a man named Galileo tried to convince the world that Earth was not the center of the universe, but that relied on a method known as heliocentrism, a systematic model that perfectly renders the notion that the Earth revolves around the sun. His views were so radical at the time that people thought he was crazy, a madman, a complete lunatic. Moreover, the Catholic Church deemed it was so heretical that the Roman Inquisition sentenced him to life on house arrest. On August 28th of 1963, a civil rights activist gave a speech that forever changed American culture. This revolutionary piece of historical rhetoric has been known as the I Have a Dream speech delivered by Martin Luther King Jr. And there are many other notable people throughout history that have expressed the views of the minority, like Galileo and Dr. King. These are your contrarians. We don't settle for the status quo. Simply because the majority approve does not pretend that it is correct. And I say we because I am a contrarian. And this contrarian mindset has made me become the successful trader I am today. And sadly, a lot of people cannot think like the contrarian, and this rejected attitude shared by the common peoples inevitably undermines the hopes and dreams that occupy most penny stock traders and inhibits them from becoming a successful trader. It's difficult for me to teach you how to think like a contrarian because I believe that if you want to become a great contrarian, you need to possess a rebellious attitude by nature. One piece of advice I can give you to help you out is based on a quote by Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. What this implies is that if we see a penny stock that has risen and traders continue to claim that the stock will rise higher and higher, it's probably a good time to start selling if you got in early, or avoid buying the stock because it could come crashing down very soon. You don't have to become a contrarian to be successful, but it certainly helps. As a contrarian, you will be despised, mocked, and ridiculed, but when you're correct and the vast majority is wrong, you will be respected. So what's a breakout trader? The price of a stock generates patterns based on historical price levels. These price levels form very explicit patterns, and when these patterns or key levels are broken, there's usually a lot of volatility. For example, some forms of martial arts use pressure points to incapacitate an opponent. And the human body has many pressure points, just like a penny stock has many crucial key levels. When a fighter strikes specific pressure points with enough force, this can cause an opponent to break down. So to become a winner, you need to know where these pressure points are located. Breakout traders identify these critical levels, or penny stock pressure points as I like to call them, and expect to make money on the volatility once a breakout occurs. This strategy is so revered that it is used by almost all traders, even those that don't trade equities. In fact, it is so prevalent in penny stocks that I dedicated a large portion of breakout trading strategies in a subsequent video, but it's far too detailed for this video. Day traders, swing traders, position traders, and scalpers are all examples of trading styles that are time dependent, meaning they are strictly focused on a particular time horizon. Day traders trade intraday, for example, and position traders hold a stock over the course of many months to many years, while other forms like breakout traders or momentum traders are more strategy focused. Think of trading styles as how long you will be holding your stock, and think of trading strategies as how you'll be trading the stock. There are other forms of styles and strategies offered, but the two styles you'll most likely encounter in penny stocks are day traders and swing traders. My personal strategy integrates multiple trading styles and strategies. I incorporate almost all of the trading styles listed into my personal trading strategy. I don't use them all at the same time, only when it's necessary. I don't stick to one particular style, otherwise I may miss an opportunity to make money. You may know the strategy definitions, but knowing when and how to use them in the market is key. And that's what I'm going to teach you throughout this series. We will be using all of the aforementioned trading strategies when I cover stock charts and stock patterns in the 5th video of this series. Market capitalization, or market cap, simply appraises the overall size of a company. A simple formula is used to compute the market cap of any company. You simply multiply the total number of outstanding shares by the price per share to get your market capitalization. So, if a company's stock price is $3, we can just multiply it by the number of shares outstanding. Now let's assume that this company has 10 million shares outstanding. When we multiply $3 by 10 million shares outstanding, we get a market cap of $30 million, which is by definition a small cap company. Larger companies like Microsoft and Walmart possess market caps in the hundreds of billions of dollars, making them mega cap companies. We can categorize market cap size as follows. Mega caps are generally companies exceeding a market capitalization of $100 billion. Some might argue that mega caps are superfluous, but my defense to that claim is that due to the overwhelming growth of inflation over the years, mega caps should be included to make it easier to classify and organize companies. If large caps were the highest classification, well, that's kind of vague because a lot of companies have more than a $10 billion market cap these days. That might not have been the case, 20 years ago. It's kind of like someone asking me what type of job I have, and I told them that I help people. Well, a lot of jobs help people, but if I had said that I was a doctor, that would make it a little more explicit. Mega caps, large caps, and mid caps will be disregarded throughout this series because penny stocks are identified as small cap, micro cap, and even nano cap stocks. Market caps are generalized estimates used by the investor community, and these numbers are subject to change. Who knows? Maybe someday we'll have trillion-dollar market caps. A lot of investors and traders make the faulty assumption that market capitalization is how we equate the value of a company. This is indisputably false. Market cap does not equate to the value of a company. If you're trying to sell your company today and you wanted to know what it was worth, you would probably use something called enterprise value, or EV. But this is outside the scope of this video series. This is actually something we had to learn in finance. In all honesty, I don't pay attention to market caps. I just focus on companies with a lot of volatility. So don't worry if you can't remember the terms or the range values. It's just good to know so you don't feel like an idiot when traders are talking about market capitalization. And as a general rule, for the sake of simplicity, I look for companies that have less than $1 billion market cap. The reason why we engage in stocks with lower market caps than larger market caps is because of the direct correlation with risk-reward and market capitalization. Before we discuss the direct correlation between risk-reward and market capitalization, I think it would be in my best interest for you to understand the nature of correlations before we continue. Correlation is a mutual relationship between two or more variables. Now, these variables can be treated as objects, events, intrinsic conditions. The arrangements are endless. For example, we can say that the demand for water increases during the summer as the temperature rises. So the two variables present in this example are the demand for water and an increase in temperature. As the temperature rises, the demand for water increases. This is your correlation. Now, correlations can be calculated by examining the data sets associated with the two variables. In this instance, if we wanted to calculate the correlation between demand for water and temperature increase, we could take the sales revenue of, say, bottled water over an extended period of time and compare it with the varying temperatures over an extended period of time. And we can incorporate correlations to penny stocks as well. Financial firms, hedge fund managers, and savvy traders are known to use correlation coefficients when comparing different financial securities. We calculate correlations using the correlation coefficient. If you've taken statistics, this equation might look familiar. Now, when I was learning this in stats, my professor had us manually calculate these problems by hand. And let me tell you, it's a very tedious process. Thankfully, we have computers that can calculate the correlation coefficient. Near the end of 2013, I noticed two 3D manufacturing companies that had similar stock patterns. 3D Systems Corporation, stock ticker DDD, and Stratasys Incorporated, stock ticker SSYS. I downloaded the data or price of the stock on a daily chart for both companies and used the correlation coefficient to measure the correlation or relationship between these two stocks. And upon my observations, I discovered that their correlation was somewhere in the vicinity of 0.90. R equaled 0.90. And this implied that the two almost mimicked each other identically. I was able to capitalize on this opportunity after Stratasys stock began to rise, yet 3D Systems stock remained stable. So, knowing that the two stocks were correlated, I bought 3D Systems stock, anticipating that it would rise because Stratasys stock had risen. What happened was that there was some kind of delay in the 3D Systems stock price for whatever reason. So were the traders reacting slowly? I really don't know. All I knew was that it was the most likely going to mimic Stratasys because the two stocks ran in tandem with each other. And that's exactly what happened, earning me a nice profit. And that's just one example of many found in the stock market. Now, hopefully you have a fundamental understanding of correlation, but understanding correlation is just half of the problem because People can easily discern correlations, but what they have difficulties with is the relationship between correlations and causality. I see this almost every day, and it really pisses me off. There is a very famous example to illustrate correlation and causality. At the break of dawn, a rooster crows as the sun begins to rise. You make the faulty assumption that the rooster is causing the sun to rise because every time it crows, the sun rises. Now, this is a prime example of a logical fallacy. This fallacy is known as the post hoc fallacy, or post hoc ergo propter hoc, which is a Latin phrase for after this, therefore, because of this. Simply because the rooster is crowing and the sun rises shortly after does not infer that the rooster is causing the sun to rise, despite the fact that the two variables are correlated. If we remove the rooster, the sun will still rise, even though the rooster was omitted from the picture. This is just a simplified example to demonstrate the causal relationships. And they get much more complicated when you involve more coherent data sets, such as an increase in CO2 levels and rising temperatures in our atmosphere. Are vehicles and pollution causing temperatures to rise? Post hoc fallacies can be written in the following form. A occurs before B, therefore A is the cause of B. In this example, A is the rooster crowing and B is the sun rising. Employing this model, we can abrogate any circumstance involving correlations, including superstitions. And yes, superstitions commit the post hoc fallacy almost religiously. If you still have difficulty trying to grasp this concept, I will try to elucidate one more time by presenting an example I fashioned myself. It's a correlation between gun laws and crime rates. And for the sake of this argument, let's assume that politicians recently outlawed guns and statistics showed that crime rates were significantly reduced. Now, most people in favor of gun laws would conclude that the gun laws were the cause of the reduced crime rate, when in fact, it was some other factor that caused the reduction in crime rate. Or perhaps the city's crime rates were already declining even before the laws were enacted, which would signify that it wasn't the gun laws after all. But based on the correlated data, where guns were banned and crime rates were reduced, may not tell the entire story, which is why we should remain skeptical. In this scenario, it might not have been the gun laws that caused the reduction in crime, but perhaps the city was undergoing the process of gentrification, where population migrations can occur. This involves lower income citizens being displaced by wealthier citizens, and many of the low income citizens were criminals, which indicated that since the low income citizens that would have engaged in violent gun related crimes were no longer living in the city to commit the crimes because they were replaced by wealthier, educated citizens who were less likely to commit crimes. Or perhaps the police force tripled, which meant more cops were patrolling the city streets, trying to prevent crime, or at least made the presence aware to suspecting criminals. There could be many reasons why crime was being reduced, but associating it with just one variable can be misleading at times, and this is why we say correlation does not always imply causality. Simply because these two specific events are correlated does not mean one was the cause of the other. It should also be noted that the same could be said if gun control laws were eradicated and everyone owned guns and crime was reduced. The post hoc fallacy stems from a misappropriation of correlated and causal relationships. And people tend to attribute their biases to whatever cause they feel like. If you're a very superstitious person, it may be difficult for you to see the flaws in your logic. If you have very strong religious convictions, it may be difficult for you to see the flaws in your logic. People only see what they want to see, and people believe what they want to believe. And logical fallacies expose the flaws in your reasoning. And I can apply this fallacy to anything from politics to religion and even the stock market. And that's why you need to be careful, because some inexperienced penny stock traders believe in the most asinine things. Many penny stock traders and investors commit the post hoc fallacy all the time. They may falsely presume that the entire stock market is healthy because of earnings growth or positive economic data, when really it's being inflated by quantitative easing. Now, in case you forgot, I wanted to teach you about correlations and causality because I wanted to explain the relationship between market capitalization and risk reward. Now, evidence exists which validates the claims that the larger the market cap, the lower risk reward, and the smaller the market cap, the greater the risk reward. What this states is that stocks with larger market caps tend to be less risky and will sustain smaller profits, and stocks like penny stocks with smaller market caps will carry more risk but generate higher profits, and this is caused by volatility. If you want investments that provide financial security and stability, you need to invest in financial instruments like bonds or index funds. As a penny stock trader, you want volatility. You want risk, since this gravitates towards significant profits and can be achieved with limited funds. Penny stocks will always encounter some form of risk, but the successful traders are the ones who know how to manage and minimize the risks associated with trading penny stocks. Before I knew anything about finance and the stock market, I always wondered why stock prices moved. I thought there was some magical force behind it all. As it turns out, the answer was more logical than magical. The stock market operates much like a free market economy, social Darwinism at its finest. It's a war between bulls and bears. Every market participant has their own opinion, bias, and interpretation on the prospective outcome of any company. Forex focuses on the global macroeconomic perspective, while penny stocks are more concerned with the microeconomic aspect of businesses. But regardless of which market you are trading or investing in, the conventional idea held by a lot of sophisticated investors and traders is that the perplexing forces that govern the price of any financial security is driven by the economic laws of supply and demand. Now, I agree to a certain extent, but my argument is that supply and demand isn't the root cause. Some aren't convinced that the markets are driven by supply and demand, and they believe the markets are efficient, and investors and traders make rational choices. Now, I can tell you right now, based on my years of experience, especially in penny stocks, investors and traders are not always rational in the short run. A lot of it involves human emotions. If every human and machine stopped placing trades, what do you think would happen? I see the answer almost every day in penny stocks. The result is that the price of the stock remains static. The price doesn't go up, the price doesn't go down, it just flatlines. We can see this when we examine stocks with no volume. The price of the stock doesn't move because nobody is buying or selling it. Now, based on this example, my conclusion is that humans and their self-interests are the foundational dynamics that affect the price of a stock. We are the cause for fluctuations of stock prices. Some make the argument that more than half of all of the stocks are traded by computers. But don't forget, humans are the ones who program the amount of risk to take in the computers, or how to react to the market, even an irrational one. Humans program the programs for now. And we can take this one step further and ask ourselves, what are our self-interests? What makes us buy one stock over another? Why are so many people selling a specific stock? These questions are examined more thoroughly in the third video of this series when we discuss one of my favorite subjects in finance, and that is behavioral finance and market psychology. It's a fairly new field of study that many schools have yet to adopt, and sadly, it's one of the most overlooked subjects in finance, yet it's probably the most important. Now, I really want to introduce this concept to you primarily because it has really helped me gain a much clearer understanding about the underlying dynamics of the stock market, but also because there isn't a lot of material either in printed textbooks or online that illustrates this relationship between supply and demand and the stock market. And given the limited number of resources available, I've created my own economic model of supply and demand by improvising some of the characteristics, namely demand shifters and supply shifters, which we'll cover later in this video. Supply and demand is probably one of the most integral conventions of economics. Its application can be applied to a number of various fields such as business or farming. It can be used to reduce wait times in lines or managing the flow of traffic in toll lanes. But most importantly, supply and demand can be used as a functional mechanism to anticipate the outcome of securities within the financial market, as well as explain what is moving the stock price. And in fact, understanding the laws of supply and demand has enabled me to increase my probability of success not just in the stock market, but in the Forex market, which involves the exchange of foreign currencies, as well as predicting the direction of crude oil, and even mastering the ability to predict the direction of gas prices at the gas pump with about a 90% accuracy. Now, I could dedicate an entire video of supply and demand, so I'm going to cover just the essentials for this video that describe the relationship between the stock market and supply and demand. An economist in the 1900s named Alfred Marshall is attributed to the development of the supply and demand graph that is usually depicted in most economic textbooks. Now, this graph, which is displayed in front of you, is representative of any market activity that can be demonstrated through the laws of supply and demand. Now, for example, using this chart, I can show you what happens to the price of orange juice if there is a shortage of oranges to produce orange juice. Or I can even demonstrate how a change in the number of vehicles in toll lanes will affect the price of the toll. And most importantly, I can also show you what happens to the price of a stock when direct or indirect circumstances influences the outcome of the company. Now, just to be clear, a market in its simplest form is a place where buyers and sellers meet to facilitate a transaction. In this example, buyers and sellers are exchanging shares of stock for money or money for shares of stock. I'm going to start with this simplified diagram of a supply and demand graph. Now, for this particular example, I'm going to use a hypothetical pharmaceutical company that trades its stock on the stock market. We'll call the company Pharma Corporation. And so this graph is going to represent the market activity, or more simply, the exchange of shares of stock available within the company between buyers and sellers. So the quantity down here, this horizontal axis, is going to be our x-axis, which is equal to the number of shares. 1,000 shares, 2,000 shares, and so on, which we'll call volume. The y-axis over here represents the price of the stock. A typical supply and demand chart will have two lines, as can be seen here. The upward sloping line is supply. Now, we can think of supply as the sellers, and the downward sloping line is demand, which is associated with buyers. But before we get into the technical aspect of supply, I'm going to focus on the characteristics of demand first. So what is demand? In layman's terms, demand for this example are the buyers in the stock market, and think of it as buyers who are demanding, quote unquote, demanding stock, okay? And demand tells us who is willing and able to buy various quantities of stock at various possible prices. And we can display this visually on the graph by drawing what is called a demand schedule, or more commonly, a demand curve. The reason we call it a demand schedule is because we can list each point on the line in a table or schedule. Remember those days when we had to plot points on a graph using x and y coordinates during algebra class? Well, this is the same concept, except we're graphing stock prices and quantities demanded. Here is your price column, and here is the quantity demanded column. In math class, the conventional method is to display the price on the x-axis and the quantity is displayed on the y-axis, but in economics, these two are reciprocated. The price is on the y-axis and the quantity or quantity demanded is on the x-axis. If we plot these points on the graph, we get a straight line, which is our demand curve. The demand curve tells us, again, who is willing and able to buy various quantities of stock at various possible prices. I had to repeat this because it is often confused with another economic term called quantity demanded. Now, quantity demanded is the quantity that buyers are willing to buy at a specific price at a specific period of time. In other words, the demand curve is the line, and quantity demanded is a specific point within that line. Before we go any further, I would like to explicate a critical element of this section, and that is the law of demand. The law of demand is a relatively easy concept to grasp if you haven't noticed it already. It is a negative or inverse relationship between price and quantity demanded, which states that, other things equal, as the price goes up, quantity demanded goes down, or when P goes down, quantity demanded goes up. We can see this in our demand schedule. As price increases, quantity demanded goes down, or as the price decreases, quantity demanded increases. So if the price of a frozen pizza is $5 per box, someone might be willing and able to buy two at that price. But if the price is lowered, you would expect more people to buy more quantities of frozen pizza. And if the price was reduced even further, say to 50 cents per box, or even free at $0, you would expect a higher quantity of frozen pizzas being sold. On the contrary, if the price of frozen pizza was offered at $30 a box, there would be significantly less quantities of frozen pizza being sold, especially if competitors are offering the pizza at a much lower price. And this is the law of demand. I think this concept seems to parallel the great economist Adam Smith's narrative of the invisible hand and how an economic society operates. We can visualize this scenario conceptually in the stock market by assuming that if we are willing and able to buy $10,000 worth of PharmaCorp stock and the price of the stock was $5 per share, well, in order to buy $10,000 worth of stock, we would have to acquire 2,000 shares of stock, right? But let's assume that the price quickly falls to $4 per share. Now that the stock price has abated to a lesser value, according to the law of demand, quantity demanded will increase because my quantity of shares required at a total of $10,000 will increase. I need to acquire more shares to satisfy the amount that I was willing and able to purchase PharmaCorp stocks. Since the new share price is $4, I would need to acquire an additional 500 shares of stock for a total of 2,500 shares, as opposed to the 2,000 shares when the price was $5 per share. Again, economists call this inverse relationship the law of demand. As the price decreases, however, you need to be careful when applying this concept to stocks because sometimes a stock may present the illusion that it is a great buying opportunity, but the stock could potentially fall even further. You have to ask yourself, why is the stock price heading lower? What is the financial condition of the company? And are they headed for bankruptcy? There are so many factors involved, which we will cover throughout the series, that explain the causes for a falling stock price. A change in quantity demanded is a movement from one data point on the line to another. Essentially, when the price of the stock changes, this will move the quantity demanded along the demand curve. The example that I provided earlier describing the law of demand and $10,000 worth of PharmaCorp stock is a prime example of a change in quantity demanded. Price changes quantity demanded, but you might ask, what or who changes the price of a stock? In the stock market, market makers have the ability to alter the buy or sell quotations, but it's the market, the buyers and sellers, who ultimately dictate the price of a stock when they decide to place a transaction based on the quotes provided by market makers. And we'll come back to this subject when I talk about market equilibrium near the end of this section. Now that we've covered some of the essential components of demand, it's time I introduce one of the most critical concepts of this section, and that is demand shifters. Understanding supply and demand shifters in conjunction with market equilibrium is what has enabled me to anticipate the outcome of the future price of most financial securities. It's an important topic, so you really need to pay attention. Just as there lies confusion between the terms demand and quantity demanded, there also lies confusion surrounding the terms a change in demand and a change in quantity demanded. Remember, a change in quantity demanded is a price movement along the demand curve. A change in demand means that every value within the demand schedule will change. So you basically disregard all of these values and replace them with an entirely new set of values for a new demand schedule. And so what this does to our supply and demand graph is that it shifts the entire demand curve either to the left or to the right. Any positive effect will shift the entire demand curve to the right, and any negative effect will shift the entire demand curve to the left. So, what constitutes a positive or negative effect? Now, in economics, you learn that there are generally 5 determinants which shift the entire demand curve. The first is taste or preferences. This determinant will shift the entire demand curve based on the tastes or preferences of a particular stock. For example, if our drug company just released positive news that they had just cured cancer, well, investors would find this to be very favorable, and so our demand curve will shift to the right because it is a positive effect. Investors and traders will dedicate preferential interest in the company, thus shifting the curve to the right. However, if the company was found engaging in illegal activity or misrepresenting the facts of their business operations, this would leave a bitter taste in the mouths of investors, and so the result of this negative effect is a demand shift to the left. The second demand shifter is the number of buyers. If there is an increase in the number of buyers, in this case traders or investors who look to acquire shares of PharmaCorp stock, this will shift the demand curve to the right. But if there is a decrease in buyers because maybe there is uncertainty in the market or investors or traders are on vacation for the holidays, this will evidently decrease demand, which will cause a shift in the demand curve to the left. The third determinant is the price of related goods, or the price of related stocks. A change in the price of a related stock will alter the demand for that stock, depending on whether or not the stock is a substitute or a complement. So, what is substitution? Let's assume that you have very similar tech companies that offer shares to the public. If one company has a higher price or might be perceived as an overvalued asset, the lesser or undervalued company might seem like a more attractive investment. Or perhaps you have competing firms within the same sector. Company B is profitably deficient and possibly heading towards bankruptcy, while company A is outperforming the other stocks within the sector. So investors and traders might gravitate to company A because it is outperforming company B. So demand would increase for company A, which would shift the demand curve to the right, and demand for company B would shift to the left, since there might be less demand for the company that is underperforming or headed towards bankruptcy. Another example is that some argue that airline stocks can be affected by oil prices, since the operating expenses for airline companies are heavily weighted by the cost of fuel. So as oil prices drive down fuel prices, this would benefit airline stocks. So you might sell oil and buy stock for airline companies through a process of substitution. Complementary stocks are pretty self-evident. They are stocks that complement one another, or they are somehow interrelated with each other. Let me illustrate with a simple analogy. If a tech company produces microchips primarily for another tech company that manufactures computers, these two companies would be complementary to each other. Or if the demand of oil companies rise, this could initiate a ripple effect that would inadvertently increase the demand in other stocks within the same sector or industry, so demand for most of the companies will increase, and the underlying result is a demand curve shifting to the right. Additionally, if demand for one company or industry were subdued by some cataclysmic event or unpredictable phenomenon, this would spontaneously induce a lot of distress to the majority of companies that fall within the confines of that particular industry or sector, thus resulting in a demand shift to the left. This is closely paralleled to a financial term known as systemic risk, not to be confused with systematic risk. So basically, if stocks in similar industries rise, their demand will increase in tandem with each other, or vice versa if the demand falls. In economics, the income demand shifter refers to income that is generated through your job or business income, and it states that a rise in income will cause an increase in demand for a particular product. Conversely, as your income falls, so too does the demand for such products. But the income demand shifter, when applied to stocks, is strictly related to the amount of capital you have at your disposal to purchase stocks and should not be associated with other sources of income. So as your trading capital rises, this will enable you to acquire more shares of stock. Therefore, you would be causing an increase in demand, shifting the curve to the right. The same is true if you incur a significant loss and your trading capital is reduced. You would generally and should acquire a lesser quantity of shares, which would decrease demand and shift the curve to the left. One thing you should never do as an investor or trader is when you lose money, you try to make up for it by acquiring a large amount of shares to make back your money. This is what we call revenge trading, and it is an easy method to lose all your money. So don't do it. Finally, the last determinant of demand is buyer expectations. If the financial outlook of a stock looks promising in the near future, investors or traders may purchase shares now in order to beat the anticipated increase in stock price, which would ultimately increase demand. Or if subsequent expectations are cynical, then this will decrease demand, shifting the curve to the left. So as the expectations of the trader or investor change with respect to a particular company, this will change or shift the demand curve depending on whether the expectations are optimistic or pessimistic. Since we've already covered some of the principles of demand and understanding the concepts, I'm going to run through the supply aspect fairly quickly because it closely reflects demand, except now, instead of taking the role as the buyer, we are looking at the scenario from the perspective of the seller. To make it simple, when we talk about supply, we're referring to the suppliers, or in the stock market example, sellers. Think of supply as being that the sellers are supplying stock to the buyers. Supply tells us who is willing and able to sell various quantities of stock that will be supplied at various possible prices. And just like before, this information is reflected in the graph by drawing a supply curve or through drawing a supply schedule. Again, quantity supplied should not be confused with supply, just as I stated with our explanation regarding demand. Quantity supplied is a specific quantity of stocks being sold at a specific time period. I generally use daily intervals for my charts, but you can apply any time frame you desire. And the law of supply is the exact opposite of the law of demand. The law of demand was an inverse relationship between price and quantity demanded, but the law of supply states that there is a direct relationship between supply and quantity supplied. Inverse simply means that when one goes up, the other goes down, or when one goes down, the other variable goes up. But with our direct relationship, this implies that as the price increases, so too does quantity supplied. Or when prices decline, quantity supplied will also decline. We can demonstrate with an unpretentious thought experiment. If you're selling any product or service, if the price increases, you'd want to sell more quantities of that product or service, right? Because this would entail more money in your pockets. But as the price falls, you would be inclined to sell less because that would allude to smaller profit margins. And if the price fell too low, you wouldn't be able to sustain a cost-effective strategy to keep your company profitable. This is the law of supply. Changes in quantity supplied are evoked by a change in price. If we look at the supply schedule and select one data point, let's say $2 at a quantity supplied of 8,000 shares, that would represent this coordinate on the graph. Now, if we select another point, let's say $4 at a quantity of 16,000, that would be this data point right here. So when the price changed from $2 to $4 and quantity supplied from 8,000 to 16,000, we say that there was a change in quantity supplied. It's simply a specific data point on the supply curve that is moved from one data point to another. We also need to provide a time frame, so we'll make it a monthly period. Just as a reminder, a change in supply is not the same as a change in quantity supplied, which we discussed just a moment ago. A change in supply means that every value within the supply schedule changes, and this will shift our supply curve either to the left or to the right. So, some of the determinants that will shift the supply curve are defined by supply shifters. When we talk about supply shifters, we're expressing a direct cause and effect relationship between certain events, which we classify as determinants, and how they will affect a shareholder's decision to sell their shares. The first supply shifter is technology. Throughout most of our history, stock transactions were executed at physical locations or stock exchanges by the direction of a stockbroker. With the improvement of technology, stock transactions were being conducted with the assistance of telephones, which has been succeeded by computers and the internet. Through these technological advancements, the cost of commission fees has been significantly reduced, and this aided the growth of the number of shares being traded on the stock market. Now, I guess you could argue that technological developments helped increase not only supply, but also demand. When improvements are made in technology, this should reduce the cost for buyers and sellers, which would shift demand and supply curves to the right. If there was a sudden rise in cost for whatever reason, you would probably see less buying and selling on the market, which would result in a demand or supply shift to the left. The second determinant is the price of other goods. This idea is similar to substitution in our determinants of demand. Let's say you currently own shares of PharmaCorp stock, but there's a company called Biotech Corp, and you find that the stock to be more appealing than PharmaCorp. You might make the decision to sell your current shares of PharmaCorp stock and acquire Biotech Corp stock. These actions will increase the supply of PharmaCorp stock, and this will create a shift in the supply curve to the right, and will also increase demand for Biotech Corp, which will shift the demand curve to the right as well, because when you buy Biotech Corp stock, this will increase demand. But if PharmaCorp stock looks promising, you might decide to refrain from selling because the shares have a positive perceived value at the current moment. So the supply curve may shift to the left due to a reduction in selling. Now, this supply shifter is very important. Number of producers or sellers is mutually related to the number of buyers in the determinants of demand. To qualify as a producer or seller, you need to currently possess shares of stock. In this example, PharmaCorp stock. When consumers make purchases, they usually don't have the intent to or obligation to resell these purchases. For instance, When you buy bananas or ice cream or alcohol as a consumer, you won't resell these items back to the market. In economics, this determinant is normally applied to consumers, but in the stock market, it's a little different. When you buy stock, you usually have the intention at some point in the future to sell the shares to a willing participant or participants. So what's happening is that as buyers accumulate shares, the demand curve gets shifted to the right as more buyers demand stock. But if they decide to sell, supply is being dumped back onto the market, and so the supply curve shifts to the right. Essentially, as more sellers enter the market, there are more shares being supplied, and this will shift the supply curve to the right. When there are fewer sellers on the market, there is a smaller quantity of supply, so the curve is shifted to the left. And this is what has triggered one of the largest catastrophes in financial history, the crash of the stock market in October of 1929. There are some contentious opinions surrounding the causes for the crash of the stock market in 1929 from varying economic fields ranging from new classical macroeconomists, Keynesians, and institutional economists arguing from a demand-driven perspective to monetarists providing their own theories or hypotheses. But my view is a little more unique, and it's based on a more naturalist perspective that I devised when I was studying the foundations of penny stock fraud and manipulation. The crash of the stock market in 1929 was actually driven by nothing more than two primitive emotions, namely greed and fear, in conjunction with an element of market manipulation. In order to understand my perspective, you need to understand what was happening in the stock market during this period. Many wealthy investors had exemplified the false promise of everlasting prosperity to the American people. Americans had called it the New Era. Some investors had encouraged everyone to buy stocks because this was the path to prosperity. And so people from grocers to newspaper delivery boys were purchasing shares of stock from one company or another. The stock market was attracting a lot of fresh, inexperienced speculators that knew nothing about how the stock market operates. All they saw were the dollar signs and how a small minority was getting wealthy through the stock market. And this led people to believe that it was easy to make money in the stock market. What this did was that it had increased demand beyond any rational level, so the demand curve gets thrown to the right. And when I talk about market equilibrium later in this section, you'll see that this excessive demand had drove the price of stocks much higher. This form of fraudulent activity is called a pump and dump. It's when investors acquire shares of stock and then they find ways to entice other speculators or other gullible participants into buying the stock, whether through misrepresentation or convincing people that this stock could make them filthy rich, or any other malicious tactic, simply for the sake of increasing demand, which artificially inflates the price of the stock. The early investors will then sell their shares for a substantial profit when the price of the stock has risen to an astronomical amount, while the unsuspecting buyers continue to buy. When the early buyers quote-unquote dump their shares, this causes a massive shift of the supply curve far to the right, as our determinant, the number of sellers, will force the price of the stock to be significantly reduced. And all of the susceptible quote-unquote suckers who bought the stock thinking that they would get rich off of it got left with nothing but worthless stock. Now, these pump and dump schemes are pervasive, and they occur on a regular basis in penny stocks. It happens all the time. If you visit the SEC's website, there are people constantly being arrested for stock manipulation and coordinating pump and dump schemes to artificially inflate the price of penny stocks. These are just the people who got caught, not including the numerous manipulators who get away. Today, this sort of practice is illegal, but prior to the Great Depression and Black Tuesday, pump and dump schemes were completely legal. Stocks were manipulated on a regular basis. A small pool of wealthy investors had attempted various deceptive strategies to attract new, credulous investors. Sometimes they would contact the press to write positive news stories in hopes that small investors would be influenced and buy stock for a company. Now today, penny stocks are often hyped by stock promoters who give a company press and make false promises such as this company will be the next Microsoft. And so this generates demand, much like what was happening during the early 1900s. What was really happening behind the scenes was that the smart money and the wealthy individuals were selling their shares of stock while everybody else was buying. And given the magnitude of shares held by the wealthy, this commencement of supply had caused the stock price to collapse. And when the small investors witness the stock prices crashing, these sellers start to panic, which causes an avalanche of supply, which pushes the price of the stocks even lower. This is why the Dow Jones tumbled by about 50% in such a short period. Now, I've been studying penny stocks and microcaps for many years, and one of my observations is that The same irrational behaviors pervading all of the unsuspecting penny stock traders that get lured into buying useless shares is exactly the same attitude that was present among many Americans in the early 1900s that had lost fortunes due to the stock market crash. It wasn't until several years later, when the Securities Exchange Act of 1934 had been enacted to prohibit stock manipulation and pump and dump type structures. So the crash of 1929 was nothing more than a highly orchestrated pump and dump scheme that I've suggested is the biggest pump and dump scheme in the history of the stock market. It was caused by a large portion of Americans being subjected to two very distinct emotional inclinations, which was greed and fear. Greed causes insatiable craving to make more money and accumulate more shares, and all this did was increase demand and artificially inflate the price of the stocks, thus making Americans much wealthier, or at least made the illusion that Americans were getting wealthier. But sadly, people today still fail to recognize these same patterns and signals that were apparent during the early 1900s. They engage in the same behaviors, compelled by hope, extreme optimism, and fueled by greed and a desire to become instantly wealthy, just as we've seen throughout our financial history and will continue to experience in the future. So I guess it's nature's way of saying stop being greedy. I know I went on a rabbit trail there, but you need to be careful when there is a substantial demand, because it could be followed by an influx of supply, which would shift the supply curve far to the right, just like what happened with the crash of 1929, tulip mania, the dot-com boom and bust, as well as countless penny stock companies. And the way I look at it is that present-day stockholders translate to future sellers. The question isn't, will people sell their shares in the future? The appropriate question is, when will they sell their shares? This determinant in economics is generally identified as taxes and subsidies, but since stocks are not eligible for subsidies, I just label it taxes. In the United States and many countries around the world that impose taxes have a very complicated structure. I bring this to your attention because these taxes can affect dividend policies for companies. Some long-term investors will favor stocks that offer high dividend payouts, while others might favor low payout dividend stocks, which are sometimes related to tax advantages. This can shift both supply and demand curves. Now, I could get into greater detail about the clientele effect, which states that investors will respond to a change in company policy by amending their portion of shares within the company, but this is beyond the scope of this video. For most stock traders, taxes bear a minimal influence on a trader's decision to place trades. Investors, however, will react to these policy changes by adjusting their quantity of shares being held. And depending on the policy change, the supply curve can shift left or to the right. Again, given the complicated nature of taxes, you should try to keep it simple by asking yourself, if the change in company policy benefits the shareholder, how will this cause a shift in the supply curve? Well, the supply curve will shift to the left because current shareholders will hold on to their shares, so there would be a reduction in shares being sold. If the company policy had an adverse effect on shareholders, this would shift the supply curve to the right because shareholders would be selling their shares. For some companies, another supply issue involving taxes occurs at the end of the year. In order to claim a tax loss on your stocks, you must sell these stocks by December 31st, so there is usually a greater quantity of supply or selling on the market near the end of the year for tax purposes, so our supply curve may get shifted to the right. Of course, a lot of these stocks may be blue chip stocks and not so much penny stocks. So this tax effect might not be applicable to many penny stock traders. Changes in future expectations from the perspective of the seller will shift the supply curve. If sellers anticipate the stock price to go higher for whatever reason, sellers will refrain from selling their shares because they anticipate the price will rise, and this will produce a greater return, and investors and traders obviously want to maximize profitability. So the supply curve may shift to the left because there would be a decrease in supply of stock on the market. In contrast, if shareholders expect the price to decline in the future, or if there is panic selling and stock prices continue to fall, which does happen a lot in the stock market, this will increase the amount of supply available, and so the supply curve is shifted to the right. Now that we've covered supply and demand, I'm going to show you how we can unify those concepts to help predict the movement of any stock price and help you understand why a stock price is moving through something called market equilibrium, also known as the market clearing price. The equilibrium price is when quantity supplied is equal to quantity demanded. It's when buyers demanding stock and sellers attempting to sell stock come to a mutual agreement regarding the price of the asset. It's like if you're negotiating the price of a new car at the dealership, the seller might be seeking a selling price to maximize their profits, but at the same time, the buyer is looking for the lowest possible price, and when both parties can form a mutual agreement on the price, the transaction takes place. And this is exactly how the stock market operates. When the market clearing price or market equilibrium is met, a stock transaction will execute. This is the price that we see displayed at stock exchanges, on the internet or any device that reveals the current price of any stock. Here's a supply and demand graph, just like the one we saw near the beginning of this section. It's essentially a demand graph and a supply graph combined. What's different about this chart is that the x-axis, this horizontal axis down here, where the quantity supplied or quantity demanded was labeled, has now been changed to denote volume. The horizontal axis now measures both quantity demanded and quantity supplied, and this is where the market is in equilibrium or quote-unquote in balance. We also can't forget to create a specific time period for this chart, so we'll go ahead and assign a time frame, say on a monthly basis. So our equilibrium price, or simply the price of the stock, is at $3, and our volume is 60,000 shares of stock for the current month. Now, it's time to incorporate the determinants of supply and demand with our market equilibrium to demonstrate how these shifts in both the supply and demand curves will affect the price of the stock. I'm going to quickly illustrate by picking random supply and demand shifters that we discussed earlier. The first demand shifter we discussed was taste and preferences. I gave an example about PharmaCorp stock releasing positive news that they had just cured cancer. Well, investors would find this to be very favorable, and so our demand curve will shift to the right because it is a positive effect. Now watch what happens to the equilibrium price when the demand curve gets shifted to the right. As the demand curve is shifted to the right, the equilibrium price now rises because quantity demanded and quantity supplied are now equal at $4. This is because demand was increasing, and this increased the price of the stock. Of course, in real life, if a drug company found the cure for cancer, the stock price would be much higher than $1. But anyways, notice how the demand curve appears to move upward, but this is just an illusion, and it's kind of confusing for people who've never studied economics before. The curve isn't rising at all. It just presents the illusion because it's moving against an upward sloping line. And the same is true when there is a decrease in demand. As the demand curve is shifted to the left, the demand curve appears to be falling, when in fact it's just moving to the left. And we can see what happens to the price of the stock when demand is reduced. The price starts to fall. Another demand shifter we talked about was buyer expectations. If the financial outlook of a stock looks promising in the near future, investors or traders may purchase shares now in order to beat the anticipated increase in stock price, which would ultimately increase demand. Or if future expectations look negative, then this will decrease demand, shifting the curve to the left. We can see what happens to the price of the stock as the demand curve is shifted to the left. The equilibrium price starts to fall. So as the expectations of the trader or investor change with respect to a particular company, this will shift the demand curve depending on whether the expectations are optimistic or pessimistic. For supply, there is the number of sellers supply shifter, which states that as more sellers enter the market, there are more shares being supplied, and this will shift the supply curve to the right. When there are fewer sellers on the market, there is a smaller quantity of supply, so the curve is shifted to the left. When the supply curve is shifted to the right, as more shares are being sold, we can see that the price of the stock begins to fall. A couple of examples with cases involving unprecedented quantities of supply was during the 1929 stock market crash and the bust of the dot-com bubble. I think there are many determinants for supply and demand that aren't listed, such as human emotion. Greed creates demand and fear causes supply. So in the event of heightened fear for a particular stock, you can expect current shareholders to sell their shares, and this will increase the supply. So the supply curve will shift to the right, and we can see how this affects the stock price. As the curve moves to the right, the price will decline. So the general rule of thumb is that when the demand curve is shifted to the right, the stock price starts to rise. Or when the supply curve shifts to the left, the price of the stock will rise. And when the demand curve is shifted to the left, the price of the stock falls. And when the supply curve is shifted to the right, the price will fall. And this is how I generally anticipate the price of the stock if and when certain financial conditions or determinants are occurring or might occur in the near future. One of the problems with this economic model of supply and demand is that, like almost everything in economics, it's all theoretical. There is always one assumption being made when there is a shift in either curve, and that is other things being equal, also known as ceteris paribus. I know it kind of sounds like words from a Harry Potter spell, but it's a Latin term that delineates all variables are assumed to remain constant. So, for example, if there's an increase in demand because preferences for a stock were favorable among investors, you assume that future expectations, demand for complementary stocks, the income determinant, or any other determinant are not being taken into consideration. But in the real world, this doesn't happen because almost all determinants are occurring simultaneously. So, investors' income might increase, which would shift the demand curve to the right, but then the demand would also shift to the left because investors are substituting the stock for a better performing stock, and future expectations look bleak, so the supply curve is shifting, and all these events are happening at the same time. So again, the assumption being made is that everything else remains constant, which doesn't seem to truly depict the exact value of our stock price by implementing this model. I sat down one day and tried to construct a solution to this problem, and what I came up with isn't feasible 100% of the time, but it's more effective than assuming ceteris paribus. And so what I came up with is that I try to analyze which determinants holds the most significance at the present moment. So if incomes are rising, expectations are changing, but then if a terrorist attack wiped out half of the state of New York, the most significant determinant might be fear or an increase in the number of sellers, which would shift the supply curve to the right, causing a massive decrease in the price of stocks because that determinant would outweigh all the others. There is one last topic we need to cover before we finalize this section. It's a term which introduces a situation when our economic model becomes unbalanced, or more precisely, when supply and demand are in a state of disequilibrium. When market makers adjust the ask price above equilibrium, this infers that quantity supplied exceeds quantity demanded, which in economics is sometimes attributed to the terms glut or a surplus. This is when quantity demanded and quantity supplied are no longer in equilibrium. In the financial markets, the ask is the minimum price that sellers are willing and able to sell at. In a hypothetical scenario, the way a stock will reach disequilibrium is when market makers adjust the price of the quotes. In this example, they raise the ask price to $4. Looking at our graph, the demand curve will tell us that at a price of $4, only 40,000 shares will be bought. However, 80,000 shares are willing to be sold at that price from sellers. Notice how I excluded able from willing and able because willingness alone is not effective in a competitively driven market. With an equilibrium price set at $3 and market makers setting the ask price of $4, this encourages 80,000 shares to be sold by sellers, but discourages many buyers from buying at such a high price. As you can see, the problem is that it created this disparity between buyers and sellers. And so market makers need to lower the ask price closer to the bid if they want the stock transactions to take place. So if nobody is placing stock transactions, then market makers aren't getting paid. So they are forcing to bring the bid and ask price closer to the market equilibrium. Think of it as a fast food retailer offering a hamburger at $50. Many fast food retailers would love the idea of selling a burger at $50 a piece, but I probably won't be able to sell at that price because consumers are not willing or able to buy at that price. So as a consequence, I would have to lower the price of my burger if I wanted to sell any. So what happens when the market maker set the price of the bid far below the equilibrium price? Any price set below the equilibrium price means that quantity demanded now exceeds quantity supplied, which is what we call a shortage, as we can see here. The quantity demanded is exceeding the market equilibrium. The price that is usually set below the equilibrium price by market makers is our bid. And the bid is the maximum price that buyers are willing and able to buy at. In this extreme scenario, if market equilibrium price is set at $3, but market makers set the price of the bid to $2, we look at the corresponding quantity supplied at $2, as well as the quantity demanded at $2, and again, this creates disparity between buyers and sellers. Sellers are willing to supply only 40,000 shares at $2, but buyers are willing to acquire 80,000 shares at that price. So, with our hamburger example, if the fast food retailer offered a hamburger at 25 cents, I might be willing to buy at 25 cents, but I probably won't be able to buy at 25 cents because the restaurant is not willing or able to sell the hamburger at that price. They aren't willing because they know other buyers would pay more for the hamburger, and the fast food retailer won't be able to sell at that price because they would be losing money rather than generating a profit. So market makers would have to raise the bid price closer to the equilibrium price to satisfy the interest between buyers and sellers. And trust me when I say this, market makers want stock transactions to take place because they generally get paid through something called the market maker spread, which is just the difference between the bid and ask price posted by the market maker. When there isn't any activity between buyers and sellers, market makers aren't getting paid from the spread. And so market makers will have to adjust the bid and ask price accordingly to prompt the facilitation of stocks within the stock market. I know this might be kind of odd, but we actually haven't properly defined what a penny stock is, and for good reasons because the definition is rather ambiguous. So what are penny stocks? What differentiates penny stocks from conventional stocks? Now, the answer might not be so obvious. In fact, there is no definitive answer to that question, which is why I'm going to expound on some of the varied definitions. Many traders like to distinguish penny stocks as any stock that trades under $5. My issue with this description is that if the stock price jumps up to $6.25 and lingers around this price level for a couple of weeks, is it no longer considered a penny stock? What if it fluctuates between $4.99 and $5.01, surpassing the $5 threshold momentarily? Is it still a penny stock, then no longer a penny stock, and then a penny stock again as the price fluctuates? Others make the assertion that the term penny stock is influenced by market capitalization. But we still run into the same issue. If a company meets the small cap requirement or criteria and transitions from a small cap company to a mid cap company by surpassing the $2 billion market cap by just a few dollars, is it no longer a penny stock? I've also seen penny stocks defined as any stock under $1, which kind of makes sense in a way, but we still run into the same problem. If the stock price is fluctuating around 99 cents and $1, its definition fluctuates as well. I believe the term penny stocks is actually a misnomer. I like to classify penny stocks as volatile stocks or high beta stocks because that's what they are and that's what we want regardless of the share price. Of course, we run into similar problems. When does a stock become volatile? Is there some definitive value for when the stock is volatile and when it's not volatile? Well, we get into a debate regarding this issue, but I'm not going to, so I'll just leave the answer to you. Now, in the media, penny stocks are portrayed with a pejorative overtone. They are infamously known for being speculative stocks riddled with scams. But I couldn't agree more. Many professional investors and traders reject penny stocks because of these flaws. The difference between me and them is that I have methods to capitalizing on these flaws. The speculations, the scams, the volatility, I show you how to exploit them and profit from them. And that's what they fail to realize is that it's easy to spot the scams before others. It's easy to manage volatility using risk management. It's easy because penny stocks are much more predictable than other financial securities. You just need to learn how to do it, and that's exactly what I'm going to teach you in all of my videos. Are you going to win 100% of the time? No. But you win more than you lose, and that's what separates the winners from the losers. Speaking of winners and losers, I'm going to discuss the topic that has always annoyed me. A large majority of traders boast about their percentage of wins in a win-to-loss ratio as if a higher win ratio equates to greater success. Well, I'm here to discredit this evasive belief. I'm here to tell you that just because you win the majority of trades, or the more trades you win, the better you are at trading, does not determine the outcome of your success, especially in the long term. What if I asked you, is it possible to stay profitable if you only win 40% of the time? How about 30% of the time? Many traders I've met would say no, but the answer to this is yes, it is possible to make money even though you lose more than 50% of the time. Here's how it works. If we imagine a hypothetical scenario involving 10 total trades, and I want to know if it's still possible to become profitable even if I won just 40% of the time. First, we need to interpret this percentage figure of 40% into actual trades. So 40% of 10 trades equates to 4 trades, and the remaining 6 trades that I lose as a percentage is 60%. So if I win 4 trades, that means I lose 6 trades, right? Or simply put, winning 40% of the trades and losing 60% of the trades is the same as winning 4 trades out of 10 and losing 6 trades out of 10 trades. What this implies is that I must generate a gain in those 4 trades larger than my 6 losses if I want to stay profitable. So to demonstrate, let's assume that I win $500 in my first trade, $270 in my second trade, $840 in my fifth trade, and let's say $460 in the 8th trade. If we add the gains of these 4 trades, this equals a total gain of $2,070. Next, we need to calculate the losses. Let's say I lose $340 in the third trade, $290 in the next, $120, $410, and $250. And on the last trade, I lose $190. Now, adding my losses, I get a total loss of $1,600. How we determine if I'm profitable is by subtracting my total gains from my total losses, and this should result in our net gain. So 2,070 minus 1,600 is $470. My net gain is $470. So this means I was able to sustain profitability despite the fact that I lost 60% of the time. You need to ensure your losses are much smaller in value relative to your wins, and that's how you become profitable by losing the majority of the time. You need to minimize your losses, and that's something I'm going to teach you how to do throughout this course. If we could maintain this level of consistency, we could become profitable even if your wins were just 30% and losses equaled 70%. The best way to do this is by cutting your losses quickly. Essentially, you lose most of your trades, but those losses are offset by very significant wins. On the contrary, is it possible to lose when you're winning more than 50% of the time? The answer to that is absolutely. Let's assume that someone wins 9 times out of 10. Translated as a percentage, this is 90%. If they win $1,000 during their first win and $1,000 the next, and $1,000 again up until their 9th consecutive win, and we add these winnings together, we get $9,000. So this person made $9,000, but here's the catch. A single loss on the 10th trade could ultimately wipe out all of the gains that were accrued during the previous 9 trades. So if their total winnings equal $9,000, and on the 10th trade this person loses $9,000, their net gain is 0. They lost everything they just made. Even though it might seem rather foolish, a lot of new penny stock traders do this. I've seen this happen from other penny stock traders and even became a victim of this debacle myself. I made consecutive gains trade after trade, but one stupid mistake wiped out all of my previous earnings. Does this happen all the time? Well, that kind of depends on one thing. How well do you manage your money? If you engage in reckless behavior like this, then you're going to experience the negative effects all the time until you have no more money to invest. I've seen people do pretty stupid things with their money, like when people hit the jackpot at the casino only to gamble it all away. So, it is possible to lose all of your gains from profitable trades. Just make sure you minimize your losses. Now you know that it's possible to become profitable even if you lose the majority of the time. Don't let your number of losses discourage you. I want you to keep studying, continue to watch my videos so that you can become a more effective penny stock trader. Make sure you check out my next video on how to place trades in the stock market.